Welcome to the deep dive. Marvell Technology's Q2 results are just out.
Record numbers, yeah.
We're digging into those, the Q3 guidance, and their big semiconductor plans. What's the real story here for you?
Well, let's get into it. The numbers look good on the surface, but there's nuance.
Okay, so let's jump right into those Q2 numbers then. Marvell reported a really stunning net revenue, $2.006 billion.
Which is a record for them.
Exactly, a record. And it's a massive 58% increase year over year. Actually came in, what, $6 million above their own guidance midpoint?
Beat their own target.
And profitability. Non-GAAP diluted income per share hit $0.67. That's an incredible 123% jump from last year.
Wow. Okay, that's serious growth on the bottom line, too.
Right. Solid non-GAAP gross margins, too, 59.4%, and operating cash flow surged up to $461.6 million. I mean, these are some eye-popping figures.
They absolutely are. And what these numbers really shout is powerful operating leverage. Well, when your earnings per share, like, more than double your revenue growth rate, that tells you the company's getting way more efficient.
Yeah.
Converting sales into actual profit.
Gotcha.
And initially, the market saw this. Marvell's stock actually climbed, what, over 3% right after the announcement? Showed real confidence.
Okay, so initial reaction positive.
But then, well, looking at it a bit later, the story kind of flipped. We saw reports saying Marvell's stock was down almost 10%.
Wait, 10% down?
Yeah.
After those results?
Yeah, citing investor disappointment, specifically with the guidance.
Okay, that's quite the whiplash for investors. We definitely need to unpack this. How can they deliver such a stellar Q2, but then immediately face this kind of negative reaction to the outlook? What's going on?
It's sort of a classic market dynamic, isn't it? Investors are always looking forward.
Right, the past is the past.
Exactly. Q2 was strong, impressive, no doubt. But the market just pivots so quickly to scrutinize the projections for the next quarter. That forward guidance, it carries immense weight, often more than past performance, really.
Okay, so that brings us directly to the Q3 outlook. Marvell's core financial outlook for fiscal 26, what are they projecting? They're forecasting net revenue of $2.060 billion, plus or minus 5%.
Okay, so slightly up sequentially from Q2's actuals.
Right. And non-GAAP diluted net income per share, expected at 74 cents, give or take 5 cents. Non-GAAP gross margin, pretty stable, 59.5% to 60.0%. And non-GAAP operating expenses, around $485 million.
Okay, now these forward-looking numbers, they already reflect a pretty big strategic move, right?
You mean the divestiture?
Exactly. The recent sale of their automotive Ethernet business, that closed on August 14th.
Ah, right.
And Marvell was clear, if that business had stayed for the full third quarter, it would have added about $60 million more to that revenue guidance.
So the underlying guidance is maybe a bit stronger than it first appears, factoring that out.
Potentially, yes. And this $2.5 billion all-cash sale, it's not just about the money. It's a very deliberate step. Marvell sharpening its focus, redirecting investment towards its core high-growth stuff.
Primarily data center, I assume.
Absolutely, especially the booming data center segment. It shows a company really streamlining aggressively.
So it's not just shedding a business. It's a real redirection of energy. What does this sharper focus mean for their core strategy then? Especially thinking about where that growth is actually coming from. Are they kind of putting all their eggs in one big, powerful basket?
That's a great question. And yeah, it absolutely means a sharper, much more concentrated strategy. That divestiture, it removes a segment that, well, it wasn't really central to their long-term high-growth vision,
Makes sense.
So this lets Marvell really double down on areas like AI and cloud services. And when you ask where the growth is coming from, it is overwhelmingly the data center.
And that's where it gets really compelling for me, the data center end market. It's just, it's the dominant engine for Marvell now.
Completely.
Q2, record $1.490 billion in revenue there.
Yeah.
That's a robust 69% year-over-year increase. And here's the kicker.
Yeah.
This segment now makes up a staggering 74% of Marvell's total revenue. Just think about that jump.
Yeah.
Up from only 34% back in fiscal 24.
It's an incredible shift.
And the drivers. Over 90% of that data center revenue, directly fueled by strong AI demand, cloud services. Like the CEO, Matt Murphy, said, Marvell's growth is being fueled by strong AI demand for our custom silicon and electro-optics products.
And what really stands out there is just how deep their engagement is in custom AI.
Right, not just off-the-shelf parts.
No, not at all. They're deeply embedded doing bespoke solutions. They reported Custom AI design activity is at an all-time high. They're engaged in over 50 new opportunities across more than 10 customers.
Wow, 50 opportunities.
That level of, client trust and co-development, it speaks volumes. And this ties right into their big long-term goal,
Which is?
expanding their data center market share from 13% today and what they saw as a $33 billion market in 2024 to hitting 20% of an expanded $94 billion market by calendar 2028.
So a bigger slice of a much bigger pie.
Precisely. They're not just riding the AI wave, they're actively building the infrastructure for it.
Okay, now this is where the plot thickens a bit, right? The lumpiness in this custom business. Sounds great long term, but how does that factor into the Q3 outlook? And maybe, just maybe, is this the reason for that investor disappointment we saw?
Ah, the lumpiness. Yes, that is absolutely critical to understanding the market's mixed reaction.
So explain that.
Well, while custom is this massive long-term driver, Marvell expects Q3 data center revenue to be basically flat sequentially.
Flat after all that growth.
Yeah, but it's not a sign of slowing demand overall. It's more like a short-term balancing act. They've got robust growth in their electro-optics products, actually projecting double-digit sequential growth there.
Yeah.
But that's being offset by a temporary dip, a kind of pause, in custom revenue this quarter.
Ah, I see.
CEO Matt Murphy was quite open about it, described custom growth as non-linear. He said the fourth quarter should be substantially stronger than the third, calling Q3 a one-quarter digestion with the recovery in Q4.
So a temporary blip expected in the custom side.
Exactly. This kind of short-term volatility, this lumpiness in bespoke custom silicon deals, it's actually quite common with these huge hyperscale builds. But yeah, it definitely seems to be a key reason, maybe the key reason for that investor disappointment with the Q3 guidance. It just momentarily overshadowed the great Q2 results.
The classic market focus on the immediate future again.
Always.
Okay, moving beyond the data center then, are we seeing any other parts of Marvell's business heating up? Any surprising comebacks, maybe? Or is everything else just overshadowed?
Well, the data center is definitely the star, no question. But other key markets are showing a pretty significant rebound, which is, encouraging.
Like what?
Enterprise networking revenue hit $193.6 million. That's up a solid 28% year over year. And carrier infrastructure, $130.1 million, surging 71% year over year.
Wow, 71% carrier.
Yeah. So collectively, those two segments grew a substantial 43% year over year.
Okay, what's driving that recovery?
It seems to be a couple of things. First, we're seeing customer inventory levels finally normalizing after that adjustment period the whole market went through.
Right, the inventory glut easing up.
Exactly. And second, strong adoption of Marvell's newer products. Their refreshed portfolio migrated to more advanced process nodes, making them more competitive.
So better tech meeting recovering demand.
Pretty much. And if you step back, the rebound looks quite dramatic. The implied annualized revenue run rate for those two markets combined in Q3, it's projected around $1.7 billion.
That's up from?
Up massively from the low point of about $900 million back in fiscal 25. So yeah, these markets aren't just recovering, they're actively embracing Marvell's newer stuff.
That's a strong turnaround story there. And speaking of streamlining, Marvell is also changing how it reports revenue, right? Starting Q4. What's behind this new communications and others segment?
Yeah, that's interesting. It prompts you to think about how companies adapt reporting to match their strategy. Starting Q4 FY2026, they'll have two main buckets, data center, unchanged, and this new communications and other.
And that lumps together.
It consolidates enterprise networking, carrier infrastructure, consumer, and what's left of the industrial part of automotive industrial.
Why do that?
The rationale seems pretty clear. The data center segment's just gotten so huge, and its growth rate's so fast, it kind of dwarfs everything else combined.
Makes sense.
So this new structure, it aims to give investors, analysts, a clearer view of performance, especially now that data center is, 3/4 of their total revenue.
Right. Clarity on where the real momentum is.
Exactly.
And just a quick note on those other markets being consolidated. Consumer did $115.9 million in Q2. Big jump quarter over quarter from gaming, but expected down sequentially in Q3.
Right.
And automotive industrial was $76.0 million, kind of flat, with Q3 expected around $35 million after that divestiture we talked about.
Yeah, reflecting this.
Okay, now let's really dive into the innovation. The tech driving this long-term vision, they're making big progress on 18 multi-generational XTU and XPU attached sockets. For those of us maybe less familiar, what exactly are we talking about here, and why are they so crucial?
Great question. So think of XPUs as basically they're specialized AI processors.
Right.
Marvell's custom silicon brains for AI
Okay.
and the XPU attached sockets. Those are the really critical ultra-high-speed connections, the plumbing that lets these powerful chips talk to each other and scale up efficiently inside these massive AI systems.
Got it. High-speed interconnects.
Exactly. And the fact that Marvell's developing 18 multi-generational versions, with several already in volume production, others ramping up, that signals a really deep, sustained commitment. It's not just one-off products. It's building a whole future-proof AI architecture.
And they're winning business with us.
Yeah, they mentioned additional design wins just since June, representing multi-billion-dollar lifetime revenue potential. It really proves their leadership here.
So they're building the core processing and the connections.
And they are incredibly well positioned for what they call the massive scale-up opportunity in AI infrastructure,
Scale up.
meaning building ever larger, more powerful AI clusters. Modern AI training, inference workloads, they demand just unprecedented low latency and multi-terabit bandwidth.
Right. Speed is everything.
Absolutely. And Marvell's playing a key role developing these scale-up switches. These support both open standard Ethernet and their own proprietary UN-link fabrics, which are purpose-built just for AI.
So they offer both standard and custom solutions there.
Right. They're leveraging their long-standing leadership in Ethernet switching, plus their own high-speed SerDes IP that's kind of the secret sauce for super fast, reliable data transfer to really lead this market shift. It's foundational tech. It determines how fast AI systems can actually think and communicate internally.
And it goes beyond just the switches, right?
Oh, yeah. Their broader interconnect portfolio is also key. You've got DSPs for active electrical cables, AECs, and active optical cables, AOCs.
DSPs. Digital signal processors.
Right. Think of them as the smarts inside the cables themselves, boosting the signal, extending the reach, maintaining speed.
Okay.
They also do retimers for things like PCI, Ethernet, ULEN. Those are chips that clean up and strengthen signals in really complex systems. And silicon photonics, using light for data transmission at insane speeds.
So soup to nuts on the connection side.
Pretty much. They're already shipping next-gen 1.6 terabit PAM DSPs in volume, and they're developing 400 gig per lane PAM tech for the next step. 3.2 terabit optical interconnects, it's just a comprehensive approach, making sure every link in the AI chain is as fast and reliable as possible.
It really sounds like they're building the literal superhighways for AI data. But with all this ambitious growth, what about those external factors? Things that could, throw a wrench in the works. Supply chain issues, tariffs, even competitive tech like LPO modules.
Right. Always critical considerations. On supply chain, leadership said execution remains tight like it is everywhere, but they're managing it effectively. Strong partnerships, proactive planning, you know the drill.
Okay, managed for now. Tariffs.
They've actually been fortunate there, haven't seen a significant impact on their business to date, but obviously they're keeping a close eye on that whole dynamic environment.
And LPO, linear pluggable optics. Is that a threat?
They mentioned it. While LPO is emerging and Marvell actually has active wins in some areas, the company seems to view it more as a niche use case for now.
Niche, really?
Yeah, they believe the vast majority of pluggable optics, for the foreseeable future anyway, will still rely on DSP-based solutions, and that's where Marvell holds a really strong position. So they're aware, but don't seem to see it as a major threat to the core strategy right now.
Okay, good to hear they're navigating those external headwinds. Let's bring it back to the money side then. How does Marvell's financial health, their capital allocation strategy, how does that underpin all these ambitious growth plans? Are they playing it safe or making bold moves with their cash?
They're definitely not playing it safe, I'd say, but they are operating from a position of real financial strength.
How so?
We touched on the strong operating leverage earlier. Their non-GAAP operating margin climbed to 34.8%. That's an impressive 870 basis point jump year over year.
That's significant margin expansion.
It is. And that robust profitability, it translates into significant cash flow, which gives them flexibility. They've already returned $540 million to shareholders through stock buybacks just in the first half of this fiscal year.
And they have more authorization for that.
Yeah, about $2 billion still authorized. Plus, their debt ratios look good and are improving. Gross debt to EBITDA at 1.63x, net debt to EBITDA at 1.19x. It's a very solid financial foundation.
So they have the firepower.
They do. And furthermore, that $2.5 billion in cash from the automotive Ethernet sale, That provides tremendous strategic capital flexibility.
Right. What are they planning to do with that?
Well, it's not just sitting there. It can be strategically deployed, could be for more stock buybacks, or perhaps more interestingly, for targeted tuck-in acquisitions.
Tuck-ins, meaning smaller deals.
Yes, smaller acquisitions that can specifically accelerate their AI roadmap, bolster those core strategic areas even faster.
Makes sense. Acquire tech or talent quickly.
Exactly. And to make sure they execute this vision, they've also made some leadership changes, promoting Chris Koopmans to president and COO, Sandeep Parathi to president of the data center group.
Strengthening the team focused on AI and cloud.
Precisely. These appointments really signal a strategic enhancement of their leadership, explicitly designed to capitalize on these huge AI and cloud market opportunities.
Okay, so let's try to wrap this deep dive up. Marvell delivered a really impressive Q2, financially strong, good operating leverage.
Definitely strong numbers.
They're making this bold strategic pivot, betting big, really, on the AI-driven data center, streamlining the business with that divestiture, reorganizing reporting for clarity.
Sharpening the focus.
And despite that short-term lumpiness in custom silicon that seemed to worry investors about Q3,
Right, the guidance reaction.
their long-term growth ambitions in AI and cloud look firmly on track, all underpinned by a strengthening financial base and a clear focus on tech leadership.
That sums it up well, which I think leaves us with an important question for you, our listener.
Go ahead.
In a market that's evolving as fast as AI infrastructure, I mean, it's incredibly high stakes.
Mhm.
How do you weigh the immediate impact of these short-term revenue bumps, these investor reactions, against a clearly articulated long-term vision, a vision aiming for market share dominance and continuous tech leadership? It's a really complex balance, isn't it? That immediate performance versus the future potential, something every investor, every market observer really has to grapple with.